Okay, we've laid out the blank documents. Now, I'm assuming at this stage that you understand assets, liabilities, expenses, and incomes. And what we would have done before is start by putting the information from this into our question. But what we're going to do now in the leave insert, this speeds things up an awful lot in the leave insert, is we're going to focus on the information at the bottom of the question, okay? So we're going to look at all of the adjustments. We're going to deal with the adjustments and put the adjustments in first. And then we'll look, once we got the adjustments dealt with, then we'll put all of the other numbers in. Okay, so we'll start off with stock 31st to 12, 61,000. So I'm going to put that in. And it goes in two places. Now the thing about these adjustments, and you get more marks for these adjustments because all of the adjustments go in somewhere twice. So advertising is for the year ended 31st to 3rd, 2002. So that means the advertising goes into next year. So that means we've paid for some of next year. So we'll have an advertising prepaid. And we will have an advertising expense. So that's a distribution cost because it tries to help us distribute goods. So there's where it goes in twice. Now, the amount of money, if I just read through the question here, it says advertising is 25,700, but not all of that was used up. So the advertising, the 25,700, we're going to use 3/4 of it this year. The reason why I got 3/4, it's for a year going into 3 months of next year. So that means we used 9 months of it this year and 3 months of it next year. So it'll be the 25,700 that we have that we're given in the question times 9/12 is going to be this year's, okay, and then the advertising prepaid current asset. So it's current asset because we've paid for something, we're owed this money back from advertising people. 25,700 times 3/12. So that's going to be our current asset. Stock of stationery on hand is 150, so that means not all of our stationery expense was used up, so we'll be taking away the prepaid. So stationery is administration, and we'll be taking away from that, we'll be taking away the stock. So the figure here it's got is 3670. But we take away the stock of 150 because we haven't used that yet. That's going to be used next year, and that's something that we have on hand, so it's a stock, it's a current asset. Okay, next. Rent due is 300, so now we go to rent. Okay, so rent is an expense, that would be an administration expense. And we have some rent, so we should have now just one thing to double check here with rent. Rent could be something that we're receiving or it could be something we're spending, but because it's in the debit column, it's an income. Okay, sorry, it's an expense, not an income. Incomes are credit, expenses are debit, so that means this rent is an expense. So we have 24 grand and we owe another 300, so that means we need to add on to the 24 grand, we need to add on the 300. Okay, so that's the real amount that I spent in rent. And then we'll move over to the current liability because we owe money. So rent due is 300, we'll put that in there. Next, provision for bad debts to be adjusted to 5% of debtors. Okay, now, so I'll read down here. Debtors is 54 grand, creditors is 48. So debtors is 54, so I'm going to put in 54 grand there. Now, provision for bad debts is going to be taken away, and provision for bad debts is 5% of debtors. So it's a minus 54 grand times 5%. So that's the provision for bad debts. Now, at the moment, the provision for bad debts is a number. If that number has to go up, and we have more provision for bad debts, then we'll have more expense. If that provision has to go down, then we'll have an income. So let's have a read and see what it says for provision for bad debts. So provision for bad debts is 1,800. That figure is now going up, so we'll have more of an expense, and it's to do with trying to sell our goods. So I'm going to put that in here as a distribution expense. So increase in provision for bad debts. Okay, now it's gone from 1800 up to 2700, so it's increased by 900. Okay. Provision for made for interest due on the loan at 10% per annum. So provision to be made means something hasn't been paid and we have to put it in as an expense that we haven't paid yet, we will have to pay. So we have a bill, so that's going to be interest due that we haven't paid yet. And if we've paid no interest, all of the amount that we should have been charged this year will be an interest due. If we paid some of it, only part of that bill, as in we haven't paid enough, so therefore the extra bit is going to be the interest due. So let's have a look and see how much is our loan first of all. So the term loan received on the 1st of the 4th is 60 grand. So I'm going to put that term loan straight in here into my capital employed section, my finance by section. So the loan is 60 grand at 10%. And we took out the loan on the 1st of the 7th, 2001. So my expense has to be 3 grand. Okay, so I'm putting that in there. So that's the amount we're actually charged. Where did I get that from? It's 10% of the 60 grand loan is 6 grand. But we got the loan at the beginning of the 7th month of the year. So we would have had 6 months interest this year, or half a year's interest. So that means 3 grand interest. Now, so I've worked out what my interest expense is. Now I need to have a look and see, did we pay any interest? So I have a quick read through here. I'm looking for interest. No mention here of any interest being paid. So I'm going to put in here, so interest paid is 0. So we paid no interest. So that means we have interest due, and that interest due is going to be the full 3 grand that we should have paid. And that's put in there as a current liability. Okay, and always I just double check, is any mention of interest there again, just in case. If it said here, for example, in our expenses that interest paid was 1 grand, then you'd have 1 grand in here, and the interest due would be 2 to bring it up to the full 3, and that 2 grand will be put in here as a current liability. Okay, moving on to the last one. So we need to do with our depreciation. So we have depreciation of, let's just move this down a little bit. So we've got buildings, equipment, and motor vehicles. Okay, so I'm going to put those in. So buildings and equipment are administration expenses. And motor vehicles is a distribution expense because it's to do with us distributing our goods. Okay, so if we deal with buildings first of all. Buildings is 2% of cost. So I'm just having a read through here. Where does it say the value of our buildings? So buildings is 550 grand. So I'm going to put that in here straight away. So buildings is 550. Now it's 2% of that, and it says accumulated depreciation. Let's have a quick look. There's accumulated depreciation motor vehicles, accumulated depreciation equipment, but there's no mention of accumulated depreciation of buildings. So that means there is no depreciation already charged. So the figure that will go on the balance sheet is whatever figure we charge for this year, and that figure for this year is going to be the 2% of the 550. So it's 550 times 0.02, 2%. So that 11 grand is our depreciation, goes in here. Okay, and our net book value is the 550, take away the 11 grand depreciation. So the exact amount we charged as depreciation expense is the figure that will go into the depreciation column here. The reason why there was no depreciation charge until now. But it's going to be different now, we're going to see for equipment. So we'll have equipment in here. So equipment is 48 grand. Okay, now at the moment accumulated depreciation on equipment is 18 grand. So I'm going to put that in there now. So that's the figure we have at the moment for depreciation of equipment, but we have this year's depreciation to calculate, and we'll add that on to the 18 grand, so that will increase that figure. So equipment is 10% of cost, so the expense for this year is going to be the 48 grand, the cost of it, times 10%. So that 48 is going to be added on to the 18 grand. So the 18 grand that we had up to this year, plus the 48 from this year. Okay, now let's just check. Yeah, that's right. Okay, so that's the figure we have for depreciation. So now we can work out net book value. So we'll subtract those two numbers. And finally, we have to work out depreciation on motor vehicles. Okay, so motor vehicles, the asset is 46 grand. And its accumulated depreciation until now is 31 grand. Now, that means they are worth at the moment, because our depreciation on this is based on book value, so the depreciation expense is going to be not a percentage of what the thing costs, but the percentage of what the thing is worth at the end of this year, before we do our depreciation, okay? So, we've taken away 31 grand depreciation over all the years. It was originally, we spent 46 grand buying it, so that means it's worth 15 grand. That's what it's worth. So the depreciation is 20% of what it's worth. So it's worth 15 grand, and we're going to multiply that by 0.2 to 20%. So that's our depreciation expense, 3 grand. So we're going to add the 3 grand onto the depreciation that we had so far. So now we can work out our net book value. Now, that's just step one. What we've done now is we've dealt with the adjustments, and we've done no maths. We haven't added up and got any totals, but we've got a huge amount of marks, because you can see already we've got an awful lot of numbers on the page. So that's the second step. Step one is laying out the blank document. Step two is dealing with the adjustments.